fundsupermart.com.
So, Robert, why don't you share with us your outlook for Europe as we go into 2013?
Sure. Given the deleveraging that a lot of those countries have to go through, we expect below trend growth for many of those countries. Interest rates should stay low. We expect also higher volatility, which, however, on the other side, also create good opportunities for investors, especially stock investors.
So what about the positive drivers for the European equity market? What sort of positive factors do you see that could drive market performance?
The positive drivers are obviously, as I mentioned, low interest rate environment, which should continue going forward, but also a lot of liquidity in the market. The European equity market is quite underweight in many of our investors' portfolios. So there's good potential for those investors to increase their equity rate in their portfolios. And on top of that, there are also some good growth companies with structural growth drivers, which should outperform the market and do quite well going forward.
Okay, but no doubt there is a huge amount of risk that's facing Europe, especially if you compare it with other developed markets. So, I mean, apart from the biggest risk of Eurozone split up, what are some of the other risks that investors need to be aware of?
I mean, obviously there's a lot of risk, as you said, the risk of a split up. So there's political risk. What might happen tomorrow, nobody really knows. On top of that, there's also the financial repression already started a bit. But on the other side, those risks also create opportunities. I mean, a lot of those risks are already priced into prices, into all of those equity prices. So valuation is depressed and you get some good quality companies at really good value.
So amid all of this risk, what's one investment opportunity that you see right now in the European equity market that's really attractive?
I think that for investors, there are many great business models, companies to invest in that are driven by long-term structural growth drivers. We at Allianz run a long-term structural growth strategy. The strategy is focusing on outstanding business models, generating high returns, sustainable in the very long term, very cash-generative business models that are managed by great management teams. They have good corporate governance, and given that they are based in Europe, valuation is also a bit depressed. So we see good opportunities to get it for a fair price. So to mention some are, for example, consumer staples companies that have great pricing power, that also benefit from their global rollout and growth in the emerging markets. Some of them are even better positioned than their global peers in the US at lower multiples. So you get higher growth, more exposure to emerging markets for lower valuation.
So for the individual investors who's looking at a European fund to invest in, what sort of advice do you have for them?
I mean, we run a European structural growth strategy at Allianz, and we really focus on those outstanding companies with great business models, with pricing power, high barriers to entry, really superior high returns, sustainable in the long term. And those are driven by underlying long-term structural growth drivers. And on back of those structural growth, then they can leverage and compound their high returns in the long term, which then in the end, after a couple of years, will really generate a lot of cash for the investors and the shareholders.
Okay, thank you for your answers.
Thank you.